Welcome to StockMarketPending.com. We're going to show the Nasdaq comp weekly chart just as we showed the Dow and the S&P. We'll try to keep this one much shorter, other than I will go into depth a little bit as this index, both the Nasdaq 100 and the Nasdaq comp, this is a Nasdaq comp, had fared much better than the S&P and the Dow in my view, because it's from the bottom over here. And what I am going to show is the same thing, is the bottom moves and what we have going on. It's the first time since we've had this bottom turnaround with the 10-week ascending, crossing above the 20-week and going higher. That was a great bull trend. Then we kind of got below the 10-week, but we regained it right away and gapped right back above it. And that's where that top was put in, where we told everyone to get out. Right here. And this week and that week. It's on StockMarketPending.com's website. And if you click on a link and go to dailystockcharts.com, you'll find it there. Here we are. Once again, welcome to StockMarketPending.com. And once again, we're going to point out to you that the Nasdaq comp did real well because of technology. And technology stocks performed very well off the bear market bottom, and they did excellent within the earnings for about 6 quarters in a row. The upcoming earnings in this Nasdaq comp and tech heavily weighted earnings, semis across the board, the earnings won't crumble right away, folks. And they're not going to be extremely bad either right away. However, it will be the peak. This July quarter of 2010 will be the peaking process of the earnings cycle. And earnings start on July 12th and will continue to go through. And the next one after will be on October. So what I want to point out here is why we're in a bear trend. Once again, 4 weeks below the 10-week, that's the blue line. Look at here, folks, it's going in the wrong direction. It too, like all the other indexes, and remember, Nasdaq has done quite well. However, it's not a bull trend because the 10-week is not flat. The 10-week has been descending and going down. And once again, look at that double bottom down here at 2150, where these two wicks are on a weekly level. That 50-week moving average is where buyers had come in over here, and they came in here. We got a 1 week, a 2 week, but look at that weekly reversal. It's much greater right here than the 2 up weeks. The 10-week, mathematically now, everything that we do at Stock Market Pending is based on mathematical equations, which don't have opinions, nor do they have what if. And they work 100%. So when that blue line is descending and crossing over the red line, just like I showed on the other indexes, is that you could take a look at the selling, the red bars. That was a relief trend. I had support there at 2150. We undercut. This pink line is a 50-week moving average. It's very important. Yeah, we undercut it. Buyers tried to come in. We got back above here. The green line happens to be a 200-week moving average. It's very significant. So we're coming down and we're testing the 200 and we're testing the 50. The bearish part, though, is that any up move needs to be sold because that 10-week, mathematically, if I show you where the 10-week was, which is right down here, I'm going to show you. The 10-week moving average was at 2407.89 here. Now look at the 10-week moving average is at 23.08. From 24.07 to 23.08 is a significant drop in the 10-week moving average. That means that any up moves have to be sold short. So nothing ever goes straight down forever. But notice that the relief rally or short cover rally was very light compared to the distribution last week. So as that 10-week continues to go down, this is ultimately going to be the new resistance will be about 2290. And basically we closed right here at 22.23, up 6.6 on the day. What I want to point out for the people that are at the mercy of the market, that don't have the right kind of education, probably don't even understand some of the things about the weekly moving averages that I'm talking about, but you can go back to the videos. We told people to sell and get out of the market here. We have those live videos. We told you sell into the strength. We were extremely overbought here. This is called a moving average convergence divergence. We started to tick down, and we've been ticking lower and lower and lower and lower and lower. And that the MACD was at ridiculous levels of 110. Well, if I show you where the MACD is now, it's only at 23. And that's that decline. When that decline happens like that mathematically, that means that the trend is very weak on a weekly level. And just like when we were calling the bottom trends over here to be net long, that blue line got flat. You closed 1, 2, 3, 4 weeks above it. The 10-week crossed above the red line, the 20-week, and it got mathematically, the wider that they get, the stronger that trend would be. And the 10-week traveled all the way on top of the 20, and it did extremely well. We sold off here. We went short here in the early part of the year, but then we reversed it and went long immediately. Now, the difference in the whole structure of using the weekly moving averages, which will always tell the truth, is where would the most selling start to happen, and why would you have time to sell into the strength? When I go below the 200 week, we kind of got below it over here in the early part of the year. But we popped up and we got back above it right away as a reversal and went through there. What will happen is